Going here. Good morning, everybody. It's 10 o'clock. We'll call the meeting to order. Item 2 on the agenda, approve the minutes of the meeting of June 12, 2014. Motion been made. Are there a second? All those in favor signify by aye. Aye. Opposed, same sign. Ayes have it. Item 3 is receive the annual actual evaluation as of December 31st, 2013. Motion made. Are there a second?
Second.
All those in favor signify by aye.
Aye.
Opposed, same sign. Ayes have it. And item 4 is a presentation by Mrs. Gates of Gabriel Roeder and Smith on our actuary evaluation report. You are on, ma'am.
Thank you, Mr. Chairman. Can everyone hear me okay?
Yes.
Great. Well, I am pleased to be here this morning. It's good to be back in Oklahoma City. I am happy that the rain held off. I was worried about that. I didn't bring an umbrella. And looking at the storm clouds last night, I realized, of course, this is tornado season, which is, tornado season in Michigan is very different from tornado season in Oklahoma. So I am pleased that the weather has passed, and I am here before you dry and happy to be here. Well, as all of you know, the purpose of our annual actuarial valuation is to assess retirement system liabilities, to measure them and assign a dollar value to them, and to come up with a contribution rate that is sufficient to fund those liabilities in an orderly manner over the working lifetimes of employees covered by this retirement system. And so one of the findings of our report, one of the key findings, is the determination of a contribution. And that is shown on page A-2 of your report. And like many public employee retirement systems, the contribution rates are expressed as percents of pay. And the computed city contribution rate that we determined in this actuarial valuation as of December 31st, 2013, it's 5.88%. This is applied to payroll, and it is used to make contributions during the city's 15-16 budget year. And based on some estimates of payroll during that period, the dollar contributions would be approximately $7.7 million. Now, actual dollar contributions will depend upon actual payroll during the period. So to the extent that it grows at a slower rate than 3.75%, contribution dollars would be lower. If it grows at a faster rate, contribution dollars would be higher. And you can see, just looking at the chart on the bottom of the page, how that compares to last year's report, and probably more significantly, how it compares to the recent study of system experience. So we do conduct a valuation on an annual basis, and that's what's shown under the heading titled 2012. But when we did that special study for the board last year, the results adopted by the board, I think, would be a more reasonable basis for comparison. And the contribution rate anticipated by that study was 6.63% as of 2012. And you can see that as of 2013, the contribution rate is 5.88% of pay. So the contribution is actually lower than anticipated. If everything had happened exactly according to actuarial expectations, the contribution rate would be 6.63% this year. But it's a little bit lower, which is certainly good news. It's always easier to present good news. People are more accepting, they're happier about it. And the reason for that is due almost entirely to the investment performance during calendar year 2013. And that is shown on pages B3 and B4 of your report. So on page B-3, we have the retirement system's financial statements. And you can see at the top of the page how those compare to the prior plan year, which is a calendar year. You can see that during 2013, contributions by employees, denoted as members here, and the city totaled about, $17.8 million. And you can see that there's almost $90 million in investment income, which is excellent. It was a very good year for the system. Under expenditures, you can see that pension payments, and that includes the lump sum payments of the $30,000 that people can elect, totaled 25.6, almost 25.7 million, and the refunds of member contributions, another $1 million. But overall, at the end of the year, assets held in trust, the value of those was about $626 million. On the following page, we have the development of the market-related asset value. This is what we use in our valuation of the plan. So it's used in determining city contributions. It's also used in measuring the retirement system's funded percent. And it's information that shows up historically on your financial statements. You can see, looking at the column titled 2013, looking at just the last 3 rows, item J shows the market rate of return net of expenses. So for calendar year 2013, that was over 16% net of expenses. The expectation was that the fund would earn 7.5% during this period. So the difference is excess investment income. That represents what we call an actuarial gain. And actuarial gains help to reduce our assessment of covered liabilities, if you will, which helps to lower city contributions. When the experience is unfavorable, it's just the opposite. Looking at the chart above, you see lots of numbers here, but the purpose of this page is to develop the market-related asset value. And so we start out at the beginning of the year with almost $550 million in assets, and we recognize contributions and pension disbursements in item D. Item F shows the phased recognition of investment gains and losses. So from our perspective, it's really the difference between investment income that was anticipated at 7.5% versus what the pension trust actually generated. We take 25% of that, we recognize it in the current year, and then we recognize an additional 25% over the next 3 years until it's fully recognized. And you can see item G, the asset value that we're actually using, is almost $590 million. It's $589.5 million. And you can see that that's lower than the market value at the same point in time, the $626 million. When you have more favorable investment experience in the pipes that you haven't yet recognized, the smoothed asset value tends to be depressed relative to market. When you have more losses than you have gains, which would have been the case right after 2008, for example, it's just the opposite. The funding value is inflated relative to market. So this is really good news for the retirement system because it means that you have about over $36 million in gains that will be released over the next 3 years. So even if you have a year next year where you're not earning 7.5%, assuming that it's not abysmal, you have this favorable experience in the pipes to help offset it. So that's certainly good news, and it's what we like to see. But the end result is an investment gain of about $9.9 million, and that's fully recognized in this valuation of the plan. On page A-4 of your report, we have a summary, really an historical schedule that shows contributions and assets of the retirement system. as well as the funded percent. The very last row on this page shows the results as of the most recent measurement date. Column 2 shows, and these are rounded to, so the results are shown in thousands. These are really, millions of dollars, but to conserve space, we're showing them in terms of thousands of dollars. So column 2 shows the value in today's dollars, or as of the measurement date, the value of liabilities for retirees and beneficiaries. So this is the value as of 12/31/13 of all the benefit payments we expect to make to retirees and their beneficiaries. It also takes into account the value of post-retirement COLA that we expect to pay over everyone's lifetime as a retiree. And you can see that that totals about $281 million. And that represents, when you compare that to the column titled Total AL, which is the total accrued liability, that represents almost 50% of the total liability. So about half of the liability of the system is due to your current benefit recipients. Column 1 and 3 in total represents the liability for employees covered by the retirement system and people that have quit and deferred their rights to pension benefits. Column 1 shows the value of those liabilities that are financed by employee contributions, because members contribute 6% of pay to the retirement system, and it represents an asset. As of the most recent measurement date, just looking at the very last column on the page, the retirement system is 101% funded. So in simple terms, it means that as of the measurement date, for every dollar of liability, you have $1.01 in system assets. So it's a great position to be in. And when you look at what's happened in prior years, you can see that the system has always been pretty well funded. During 2008, you can see that the funded ratio started to drop, really recognizing some of the losses due to the market downturn in 2008, but steady improvement due to good investment performance and some of the plan changes that were implemented recently. So overall, lots of good news. On page A-5 of your report, we have comments. In addition, I would add that in addition to the favorable investment experience during 2013, another source of favorable experience, although it's really sort of second fiddle to the investment experience, would be favorable experience among retirees. The post-retirement COLA paid to retirees was lower than anticipated. Our expectation is that it would be about 2% per year, and during 2013 it was less than that. I think it was about 1.5%. So to the extent that COLA isn't getting paid out at the assumed rate, it's another source of favorable experience. Looking at comment E, many of you may be aware that the retirement system has new financial reporting requirements, the new Governmental Accounting Standards Board Statements 67 and 68. 67 affects the pension plan, and we will be working with the city to ensure that the plan is fully compliant with respect to these new reporting requirements. But we are recommending that the board establish a formal funding policy which will be needed to comply with these new accounting standards. And this is really a simple statement that describes how the retirement system is financing benefits. And we can work with the board, through Renee, to develop a simple statement that will be used in connection with these new accounting standards. We want to make sure that you have a successful audit. We don't want any glitches. We don't want any delays. and this is part of complying with the new standards. So,
When does those policies have to be in effect?
well, your plan year ended June 30, but the audit would begin later this summer? Early stages? Okay. We could have something ready for the board to review at your August meeting.
Okay.
So do we need to have it in place prior to the audit? Is that something we'll have that's consistent with, is that something that we'll have, that the state will basically be consistent with what we have within our ordinance, with the pension ordinance, where it talks about funding the full annual required contribution and? Okay. Okay.
Thank you.
Are there, hi Dennis, are there any other questions or comments?
Yes. Did I read something recently about new mortality tables being introduced? How's that going? When will that affect us, if it does, and when?
You're probably referring to the 2014 tables. My understanding is that they have not been, I'm not sure that they're available just yet. We did recently do a study of retirement system experience, which included a review of longevity, life expectancy among system retirees. And as part of that study, we looked to what was happening at the statewide plan, the OPERS plan, the Oklahoma Public Employees System, because it would be the group that would be comparable to your system, and it has a much larger population, which would make the experience a little more credible. And it appears, and I'm sorry to report this, that longevity improvement among Oklahoma citizens seems to be lagging behind what we see in other regions of the country. So that's the bad news today. And as a result of the analysis done at the state level, the retirement system is currently using that table, which is, I think, RP 2000 projected to 2010. So the 2014 table would reflect even greater mortality improvement. So I think our approach would be effective with the next experience study, which would probably take place in another 5 or more years. We would again review system experience, and we would compare it to what's happening at the state level, and then make an adjustment at that time. And I would not be surprised if the improvements are not as great as what we're seeing elsewhere in the country. And as a result, we probably would not reflect fully the provisions or the rates of the newest table. To do that would be to sort of advance fund longevity improvements at a pretty aggressive rate, and they may or may not occur. The disadvantage that has is that we end up overstating system liabilities. So it's conservative, but there are other considerations. We want our assessment of liabilities to be reasonable and to not present a burden for taxpayers and the city for financing the liabilities.
Any other board members got any questions?
A quick question. It's my understanding that the new reporting requirements are pretty significant, and we're going to talk about the budget here, I guess, a little bit later in the agenda. And it's set at the same as it was last year. Have we determined what the impact to that's going to be?
We had the experience study last year that had additional cost. It's about almost the same amount that we'll be using for the additional work that we've done with the data and standards that is already included in the budget.
That's great.
Amount requested from the prior year.
Great. Thank you.
Any other questions? If not, thank you so much.
My pleasure.
Thank you. Okay, Items B, C, and D, can we move those to the heel of the docket and get the rest of the agenda out of the way? Moved, motion been made, are there a second? All those in favor signify by aye. Aye. Opposed, same sign, ayes have it. And also, V5, we need to do that too. Move it to the heel. Motion been made, second, all those in favor signify by aye. Aye. Opposed, same sign, ayes have it. Okay, item 6 is ratify the approval of payroll for the month of June 2014. Motion been made and seconded. All those in favor signify by aye. Aye. Opposed, same sign. Ayes have it. Item 7 is approve the claims docket. Motion been made. Are there a second? All those in favor signify by aye. Aye. Opposed, same sign. Ayes have it. Item 8 is approve the following applications for service retirement. 1, 2, 3, 4, 5. Motion been made. Are there a second? All those in favor signify by aye. Aye. Opposed, same sign. Ayes have it. Item 9 is receive report of death and approve the continuation of the pension to the spouse.
Move it.
Motion been made and seconded. All those in favor signify by aye. Aye. Opposed, same sign. Ayes have it. Item 10 is receive the report of death and authorize the secretary to make the necessary changes to conform to the following.
Move it.
Motion been made. Are there a second? All those in favor signify by aye. Aye. Opposed, same sign. Ayes have it. Item 11 is received presentation from Renee Flowers or her representative concerning her application for disability in the line of duty. Application as permitted under disability allowance provision 4106 Municipal Code 2010. Counselor, what do we need to go into executive session? She's not here. What's the board's pleasure? You want to go back and go into executive session?
I think we'll have some evidence. I agree.
Okay. Are there a motion to go into executive session? Motion been made. Are there a second? Second. Okay. Roll call, please, ma'am.
Diana Berry? Yes. Paul Bronson? Yes. Craig Freeman?
Yes.
James Hamill? David Shue?
Yes.
Dennis Spencer?
Yes.
Jim Williamson?
Yes.
And King Culver? Yes. And Debbie B. Smith?
Yes. Okay. All right, we're back out of executive session at 10:28. I'd entertain a motion.
I would move approval of the application for this building.
All right, motion been made and seconded. All those in favor signify by aye. Aye. Opposed, same sign. Ayes have it. Okay. Andrew, are the presenters here?
They are.
Do you want to say a few words before we get started?
Yeah, just really briefly, I'll just give you a very broad picture of the three
Okay.
managers. So you have three commodity managers coming in today to present a fun-filled, packed day. Gresham, core commodity, and then Blackstone. Blackstone will be first, then core commodity, and then Gresham. Just a broad picture, I think, that will kind of help you go through these just to see where, if you imagine a risk-return chart where the bottom left is the least risk, least reward, and then at the top right, most risk, most reward. You kind of have core commodity down there, which is more of an index-like strategy. They have the same allocations as an index always. They manage the roll yield, and that is all. They'll discuss that with you. Stepping up a little bit on the risk-return spectrum, you have Gresham. They're sort of the middle between Blackstone and core commodity. They manage the roll yield, but they will also opportunistically overweight and underweight certain sectors based on their economic views. And then finally, more at the top of the risk-return spectrum, you have our first presenters, Blackstone. They're a fund of funds. They own 5 underlying strategies, so they don't actually purchase the forward commodity contracts. They hire and fire underlying money managers in their funds. They have the ability to overweight and underweight sectors. They historically have a pretty big allocation to the energy sector, but they also have the ability to short, which the other two managers do not. So pretty sizable difference between them and the other two. So that's just a quick high-level picture on them. Unless you have any questions, we can get started.
Is that graphed anywhere in your document?
You know what? The best way to see it is if you go to the third tab, page 13, you can see the standard deviation in that on the bottom chart here, and that's going to show you over 5 years. 10 years, Blackstone and core commodity don't have the track record, but over 5 years you can look at it and you can see which one's the higher standard deviation, the more volatility, which is the more risk. So we don't actually have that charted, but that's just sort of the lay of the land with the three.
Is that something if we're comparing managers that you just go ahead and put that graph in?
Yeah, we definitely
that'd just be helpful just to have that visually.
No,
'Cause I think all the information is here, I just didn't see the graph.
Yeah, we can certainly add risk
Okay,
return charts.
thank you.
Okay.
Any other questions? Okay.
Okay,
If you get the first presenter, sir.
I told them 30 minutes.
Yeah, that 30's, yeah.
So again, first up, we have Blackstone, Charles, and Colin.
Good morning, gentlemen. We got 2 microphones, so if you all want to,
Oh, great.
Bud and Jeffers, whichever way, if you want to stay there at the center one, whichever way. Good morning.
Good morning. How are you all? Good. So I guess we should get right into it. My name is Charles Pamonti, here from Blackstone Alternative Asset Management. I'm joined by my colleague Colin Vick. First of all, we'd like to thank you very much for the invitation to come in and meet with you all and talk to you a little bit about our Resources Select strategy, which is our long bias commodity strategy that we have had since 2007. I'd also like to thank Asset Consulting Group for the invitation. So I understand we have, I guess, about 30 minutes. We can keep it brief. We'll save some time for questions as well. What I'd like to do is have Colin walk you through just a couple minutes on our firm in general, so who we are, what we do, the team that we have in place, both across the firm but then specific to the commodity strategy. And then I will walk you through exactly what we're trying to achieve with this strategy, what our track record has been, how we've constructed it, and then leave some time for questions. So with that, I'll turn it over to Colin just to give you an overview of our business.
Thanks, Charles, and thank you for having us in there. Like Charles mentioned, I'll keep it brief because the meat and potatoes of the presentation is about the commodity strategy, and I think the most interesting part of it. So if all of you have presentations, I think the most appropriate place to start is on page 4, which starts with the inception of the firm. So in 1985, Blackstone was founded by Steve Schwarzman and Pete Peterson, primarily on a private equity and advisory basis. But coincidentally, in 1990 is when the hedge fund solutions groups began, and that's Blackstone Alternative Asset Management, right there in the middle in the magenta color, I think it is. So as Steve and Pete began receiving capital back from their private equity investments, they were looking to diversify away from their alternatives portfolio and look to hedge funds as a way to get exposure to relatively more liquid investments and coincidentally to diversify their portfolios in an uncorrelated asset class to traditional equity markets. So that began in 1990, and fast forward to today, we manage $58 billion of discretionary assets, and which makes us the largest allocator to hedge funds in the world. And what the size and scale really does for us, it allows us to customize exposures with managers and negotiate with managers to reduce fees on behalf of our clients. And so with that being said, at $58 billion of assets, it's important to note that not all of these assets are in one specific strategy. They're not all in the commodity strategy. They're not all in our diversified strategy, but across a very strategy-specific group of funds. And at page 5 really shows how our assets are distributed across our firm. And more specific to today's discussion is our long-only and long-bias strategy, and that's our Resources Select commodity strategy right there in the middle at $3.5 billion. And Charles will elaborate more on the details of that strategy a little bit later on. But I want to highlight at the very bottom the high alignment of interest that Blackstone has amongst its clients. We allocate not only firm capital, but BX employee capital and partner capital alongside our clients subject to the same terms and liquidity constraints as our clients. So over $1.5 billion of our capital sits along our investors' capital, which provides for a very high alignment of interest. So with a robust growing business, we have to complement that with a robust employee set. So on page 6 really highlights kind of the depth and experience of our team. You can see that we have over 230 professionals. 100 of those professionals are investment professionals. They are solely dedicated to the underwriting and due diligence of our hedge fund managers. And with that being said, around 50 professionals are front office investment professionals focusing on the analytics of those hedge funds. We have 3 dedicated individuals solely based to commodities. And you can see on the very top line, there's Jay Tomlinson-Hill, our CEO, but right below that is Kristen Eshak. She's a senior managing director and partner of the firm, and she is head of the commodity strategy and co-head of our European office. She's very instrumental in the creation of this Resources Select strategy back in 2007. And so with a very seasoned management team of over 9 years, we have a very strong presence at the senior level, but it's important to note that the bench and supporting staff is very robust. Specific to Resources Select, we have a dedicated risk management team that monitors the benchmark that the Resources Select is monitored against. Also, we have a monitoring committee or operational committee that details and follows the calculations and the methods of how managers are paid and how Resources Select performs against various indices. Additionally, our business and financial evaluation team, I'd be remiss if I didn't mention them. They are ex-auditors. They have an extensive history of doing due diligence on hedge fund managers, making sure that we don't invest in any hedge fund managers that are subject to operational fraud or failure. And since the inception of the firm, we've never invested in any manager that has gone out of business due to operational fraud or organizational failure. So we're very comfortable underwriting investment risk, but we're never comfortable underwriting organizational risk. And with that being said, the majority of our hires have experience trading that specific asset class that they're here responsible for at Blackstone. And page 7 highlights that at a very high level. And just for a point of reference, Kristen Eshak near the top has experience trading commodities and structuring products at J.P. Morgan. And lastly, what does that all mean? We have a very robust business, a very experienced team. And what that allows us to do is really highlight it on page 8, and it really kind of transitions to the Resource Select strategy specifically with our differentiated business model. The size and scale of our business allows us to negotiate fees with underlying managers. So we go to a manager and say, we want to invest in your business, but we don't want to pay the 2 and 20 that you're charging. Because we're a very stable capital, we want to pay you half of your management fee and half of your incentive fee, and that's just an example. And Charles can discuss the details of the fees that we pay the underlying managers and Resources Select in a moment. Because of our size and depth of our team, we're able to due diligence on any manager in the universe, regardless of size and regardless of geography. So the manager size chart on the left-hand side really should read manager sourcing, our capability of sourcing talent regardless of the size or strategy that they trade in. And lastly, on the right-hand side, negotiated structures and transactions. In addition to negotiating fees and capacity with managers, we have the ability to go to them and say, we want to create a customized vehicle, a customized exposure only for Blackstone and only for our clients. And that is actually exactly what we did for Resources Select. The 4 managers that are in Resources Select are all customized exposures, customized vehicles only for our investors. We negotiated liquidity as well as the capacity and have oversight of how they trade the specific asset class and the securities that they trade. So with that being said, it's a broad overview of the business and how we differentiate ourselves from our competitors. And if you have any questions on the overall business, I'd be happy to answer that. Otherwise, I'll let Charles discuss the commodity strategy.
Okay. Thanks, Colin. So I'm going to focus on the second section in the presentation, which really gets into the strategy itself. Before we turn to a slide, I just want to say a couple comments that give you some background on why we started this strategy. So back in 2006, we were working with a very large U.S. public pension plan that had been a long-time investor in commodities. The main way that they were accessing the commodities markets were to invest in the GSCI and the Dow Jones UBS, which are the 2 main passive commodity indices that you can invest in. What they recognized is that although they had made the right call in terms of buying commodities at the right time where prices were increasing, due to some of the structural flaws of the way the index is set up, they were actually losing a portion of that positive return just due to the shape of the forward curve and the way the index is managed and set up. And I can talk about that in a little bit more detail, but basically they came to us and said, we think that there's a value in partnering with you, BAM, if you can create a commodity strategy that allows us to be long commodities, so we want to own them, we want to be able to hedge inflation over time. We think that there makes sense to own commodities because of their diversification benefits. They tend to be less correlated to other asset classes. But we also think that there's a value if you can choose the right managers and structure it the right way, where if we can give the underlying managers in the fund some flexibility around the way that they trade and own the commodities, that we think you can actually outperform the passive indices. And so that's really what we tried to accomplish with this strategy. And basically what we've done, cumulative since inception, is this strategy has outperformed the 2 main passive commodity indices by over 40% in both cases. And where you see that is on the first page within Section 2, page 13. So what you're looking at here is cumulative since inception, and you look on the lower left-hand side here, and you see that if you look at Resources Select performance versus both the GSCI and the Dow Jones UBS, the relative performance, which is essentially the outperformance, is over 40%. So how are we actually achieving this? On the bottom right-hand side, you basically see the source of that outperformance. Where is it coming from? So you see just over a third of that outperformance is coming from the BXCI, which is the custom index that we've created. This is the index that we benchmark the managers against, and I'll talk to you in just a moment about that. But you see the majority of this outperformance is coming from active management. So allocating the capital to underlying managers that are managing that capital in a flexible way, where they can make fundamental calls on different commodities, all within certain guidelines that allows them to, over time, hopefully outperform the main passive indices. And we'll just turn to page 14. What you see here is the BXCI. This is the custom index that we've created that we are benchmarking our managers against. So when we set out to create this strategy, we wanted to have a benchmark that really gave our investors very broad inclusion across a very wide array of different commodities. So all we really did here is nothing too complicated. We took the main two passive indices, the GSCI and the Dow Jones UBS, and we took 50% of each of them. So that's not too difficult. What we also did is we equally weighted WTI and Brent crude, which are the two oil contracts. The reason we did that is Brent crude, about 2/3 of the world's oil is actually priced off of that contract, and we thought it should have equal representation in this particular index. So we create this index, which we think is a more difficult index for the managers to beat, and the reason that that's important is because the managers in this fund are only paid their performance fee on their ability to outperform their specific piece of this benchmark. So as an example, if you look at the energy here, so you see 50.77% of the benchmark is in energy. So this drives the capital allocation to the managers. So we say, okay, 50.77% of the capital in our strategy should be allocated to the energy manager. Now, they are only going to make their performance fee if they are able to outperform however the energy piece of this index performs. So we think that's a strong alignment where you're really only getting paid the majority of your fees if you're generating substantial performance above what the markets are doing in general. On page 15, I'll just touch on very, very briefly. This starts to get very technical into how our index is different. I think the most relevant point here is just that I had mentioned some of the structural flaws of the passive indices. Mainly, the passive indices reflect the front month contract in particularly in the energy space in the oil market. So all that really means is if you're in a certain type of environment where the future price of oil is trading above where the current price of oil is, then basically you're in an upward sloping curve. Now, the main passive indices will hold the front month. However, each month they have to roll that contract so that they don't actually take physical delivery of the commodity. So each month what they'll do is they will sell that front month and then buy the next month. If that's an upward sloping curve, they're basically always, month in, month out, selling low and buying high, and that creates a performance drag. So our index is designed so that we stay away from the front month contract within the oil space, and we spread that exposure across the curve a little bit further out where it's flatter. So that's index construction. Now, getting down to what the managers are actually doing, page 17. So I'll highlight a few things for you here. The concept overall is we've got this fund, it's long bias, so our investors should essentially be long commodities over time. But what we're doing is we're giving the capital to commodities-related hedge fund managers. And so what we wanted to do is make sure that we had the right guidelines in place with each of these underlying managers so that they manage capital according to those guidelines and so that you, as the investor, are always long biased to commodities. If you're trying to hedge inflation, if you want the diversification benefits of commodities, you need to own them. And so for that reason, we want to make sure that you never end up in a situation where the manager is actually short a commodity, but the markets rallied and that commodity did really well and you didn't have exposure. So for that reason, we have very tight guidelines around how the managers can trade the capital. So what you see here is we regulate the markets they trade on. We even regulate what they can do with their excess cash. We want to make sure that they invest their excess cash in T-bills or Fed funds, so more safe, less risky types of investments. But the real key to active management comes from this middle column here, portfolio restrictions. So what we're saying to managers are, so I'll take metals as an example. We have a metals manager in the fund. We say, we want you to maintain your exposure to the benchmark between 50% and 150%. Now, what that means is they don't have to be 100% exposed to the benchmark. So we're giving them some flexibility. If they feel that it's a bearish environment and that they want to essentially get out of the way of a lot of market volatility, they can take their exposure down to 50%. So they can effectively be underweight the benchmark. If, on the flip side, they feel like they're in a really bullish environment, and from a fundamental standpoint, they would like to be overweight the benchmark, they can take that up to 150% of the piece of that benchmark that they own. So we're giving them flexibility within a relatively tight band, but if you contrast that to just passively owning the index, you own 100% of everything at all times. So you don't have that extra flexibility. This flexibility has generated a lot of that outperformance, because if you look at particular markets like oil and you look at a year like 2008 where there was obviously a huge run-up and then a huge sell-off, being able to be with an oil manager that could take their exposure down in that sell-off but be overweight as the price was increasing pretty rapidly, that's where you get a lot of that outperformance from. And to Colin's comments around operational due diligence, it's really important for us to be able to monitor our investments. And so we have a lot of transparency, actually full transparency, into what each of these managers are doing. We receive customized reporting and detailed attribution from each of these managers, but very important, we also receive a monthly statement from each of the managers that's signed by a senior executive saying that they stayed within the guidelines of this fund throughout the course of the month, and that's something that we closely monitor. On page 18, you see the breakdown of the different managers. This is a concentrated approach by design. So there are only 4 managers in the Resources Select Fund. Remember, when we were looking at the index, I mentioned that that determines how we allocate the capital to the managers. So you saw 50.77% of the index in energy. You see about 50% of Resources Select is with the energy manager, which is Aston Beck. And then our metals manager is Galena, and then we have 2 different ags managers. I think the common theme across these managers is we really wanted to take a concentrated approach. We wanted to find specialist managers in each of the major areas of the commodities markets. And to Colin's comments about customization, some of these managers were not even in a hedge fund context when we first discovered them, but we actually used the scale of our business to help put them in business and help them start a hedge fund. All of these managers are managing the Resources Select capital in a custom vehicle that is subject to the guidelines that we discussed. So this is separate from whatever main hedge fund they may have, because this is a different product and they're managing the capital in a different way, so we have that separated out.
Charles, can you just give like a 30-second overview on each of the underlying managers, where they're located, and sort of what their business is like outside of...
Sure. Yeah, sure. So I think, you know, one of the common themes across these managers is we really looked for a lot of trading expertise, as you might imagine, but also very close ties to the physical markets. So many of these managers are affiliated with large commodity trade houses. There was actually an article in the Wall Street Journal today about some of the large commodity trade houses. But Aston Beck, which is the oil manager, this was an oil trader that at the time we met him was within Citigroup, so did not have his own fund, within the Fibro arm of Citigroup. We actually helped him create his own fund. For a while, he was partially owned by Occidental Petroleum. but he's a standalone manager. That manager manages oil, in our opinion, really one of the best oil traders out there. His firm is based in Connecticut, and I believe he may also have offices in London. Galena, which is the metals manager, is actually a part of the Trafigura Group, which is a large commodity trade house. They are based overseas in London. Yanix and Adisia are the two AGS managers. Yanix is based in Connecticut, and Adisia is actually just a different name for this particular business within Louis Dreyfus, which is a large commodity trade house as well. So that's something we were looking for. We're looking for trading talent with a solid track record, but we were also, and a high level of specialization, but we were also looking for some type of connection with some of these larger commodities businesses. And there's, just so you know, I won't go through it just in the interest of time, but on page 19, there are a couple more bullets on each of the managers there. So I think just in the interest of time, I'll turn to performance very briefly, and then we can talk about the terms of the fund. On page 20, you see the performance both for the current month so far this year and then cumulative since inception. So I think just given that it's a longer time period, if you look at year-to-date or cumulative since inception, maybe just starting with year-to-date, there's a lot of information here, but basically what we're showing is for each of the different managers, what their percent allocation is, how much they've generated in performance, and how that stacks up versus both our index as well as the other two main passive indices. And really what we're focused on is the column that's titled alpha generation. So what we just mean by alpha generation is the outperformance that this manager has achieved. So what you see is Aston Beck has achieved outperformance of about 10% so far year to date. You see the metals manager, Galena, has achieved about 2.5% outperformance on a year to date. Flip side is you see that one of the AGS managers has had a little bit of a difficult time so far this year, a lot of that based with the fact that the AGS markets have had a lot of volatility of late. But you see on the total for the fund that you've got 2.3% outperformance versus the BXCI, and you've got close to 7% net performance for the fund so far this year. Of course, to my comments earlier, when you look at the alpha generation cumulative since inception, you would expect to see a much higher number as you do here. And this is just a reflection of how the portfolio is currently allocated.
And just to chime in real quick on the June performance, it's not in the book because when we created it, June performances weren't finalized, but we have estimates that the fund is currently up approximately 1.9% for the month of June, so very attractive returns from an alpha generative standpoint as well as an absolute return standpoint for the managers.
And maybe just to wrap up, on page 23, you see the terms of the fund. So we accept subscriptions on a monthly basis, 35 days prior written notice, monthly redemption, which is actually, probably the most liquid strategy that we have in that an investor can, subject to the 35 days, get out on a monthly basis. There are a couple of different fee options here, either a flat management fee or a management and performance fee combination. So that's entirely based on what your preference is. I will mention, as Colin alluded to, that we are not paying typical hedge fund fees at the underlying level in this portfolio. The managers are creating these custom vehicles for us. Along with that, we're active fee negotiations where, on average, if you believe that the average across the industry is a 2% management fee and a 20% incentive fee for a hedge fund, in this particular fund, on a blended basis, it's 70 basis points on the management fee side. But then the incentive fee side is around 20, But as I mentioned, the way that we've structured the index and the way the managers are paid, we're okay with paying a performance fee based on the way that this is structured, provided that that manager is able to outperform their benchmark. So I will pause there and see if there are any questions that we can answer.
Any questions from board members?
I just have one. What's the pros and cons and of a Cayman Islands exempted company?
I'm sorry.
Cayman Islands exempted company?
Yeah.
That's your structure, is that correct?
Yeah, the pros and cons.
What exactly is that?
It's just the offshore structure from a tax purposes. We have an onshore structure for taxable investors. I think it's just a point of whether the investor is taxable or non-taxable.
I was thinking that was your structure, is that not?
The offshore vehicle is of Resources Select is Cayman Islands, just for offshore investors or non-taxable U.S. investors. If you are taxable, there's an LP structure as well.
Any other questions? Well, if none, we thank you for your time, and
Okay, thank you
I hope you
all.
enjoy your stay in Oklahoma City.
We did. Thank you very much.
Okay, sir.
Thank you.
Who's up next, Andrew? Okay.
Yeah. I might. Oh, I asked. WB, if we need to have a due diligence trip on that deal, I'll be glad to check out that structure. Yeah. Well, that's what you get for being late. I jumped on it fast. Did you?
So next up, we have Dan from Core Commodity, and as I said, they're sort of, out of the three that we're looking at today, the most index-like, not an index strategy by any means, but the most index-like out of the three.
Thanks for the introduction.
Good morning, sir. Got about 30 minutes, and
Perfect. Starting right on time.
all right, sir.
WB, Andrew, ACG, trustees of the board, I appreciate you inviting Core Commodity Management to present our firm experience and our Diversified One program to you today. We've done a lot of work with ACG in terms of working with the research team to educate them on our strategies, and hopefully today we can become partners with OSERS as well. I think in the next 30 minutes, my goal really is to leave you all with an impression of a couple things. One, our decades of experience in the asset class. Commodities, in terms of being institutionally accepted and followed, is relatively new compared to the worlds of equities and fixed income. Two, I'll try to describe a bit about what makes us unique versus our competitors. You certainly can't go wrong with any of the three managers you'll meet today, but hopefully I'll leave you with an idea of the sort of uniqueness of our approach as well as where we try to add value. I think a bit to what Andrew just said in terms of the enhanced index approach. We have various strategies which have different levels of additional risk with different levels of additional targeted return. Of course, today I'll talk to you about Diversified One, which is our closest to index-like profile in terms of risk metrics. And sort of giving you a little bit, stepping back and just talking a little bit briefly, albeit, about the firm, Core Commodity Management is a $6 billion asset manager, independently owned by senior management, which I think has implications specifically in the commodity space. What you'll find is that in the news we've read recently, JP Morgan sold their physical metals business, UBS has pulled out, there are other asset managers who either are affiliated with sell-side investment banks or larger asset managers where commodities is one sleeve or one silo. I think at Core Commodity Management, what makes us unique, different, and better suited to be here for the long haul is that commodities is all we've done. Commodities is all that we do. So there's no one who can sort of get involved in the day-to-day or the bigger picture management of the firm. Talking about the principles of the firm, there are two co-founders / co-presidents. A gentleman by the name of Brad Klein has been trading commodities for over 30 years, started at Drexel in the late 70s, moved to AIG and ran their metals and currency business. And then the other co-founder is our portfolio manager, a gentleman by the name of Adam De Chiara. Adam has built a nice reputation in the asset class, having started at the commodity division of Goldman Sachs in 1991, then known as J. Aron. Also in 1991, he was assigned to be the first head trader of the Goldman Sachs Commodity Index. Now, the Goldman Sachs Commodity Index was the first commodity index widely followed or adopted at all in terms of an asset allocation framework for institutional investors to follow or to invest in. Now, that started, like I said, in 1991 with $20 million of investment. Now, fast forward 25 years, there's approximately $300 billion of assets, all following the Dow Jones UBS Commodity Index, recently renamed the Bloomberg Commodity Index, which I believe is your benchmark, and also this Goldman Sachs Commodity Index. So Adam was at the forefront of creating and trading this index 2 decades ago and has since just stuck to his knitting and been an index provider for institutions like yourselves ever since. Now, in 1994, Brad hired Adam away from Goldman to create a competing index at AIG, and together they created the DJ AIG Commodity Index. That was launched in 1998. So Adam is the father or one of the creators of this index. And then in 2003, Adam and Brad moved to the current platform where we are Core Commodity Management to strike out on their own, if you will. Now, since 2003, we have, again, solely focused on commodities. From 03 to 08, the market was largely accessing the asset class through over-the-counter notes and swaps, and that was our business. Not until 2008 did we launch the products that I'm talking to you about today, but in actuality, the framework and the underlying thesis behind or underneath all of these strategies has really been at the heart of what we've been doing for over 2 decades. Now, that swap business is completely shuttered. The $6 billion of third-party assets, which we manage in a fiduciary manner, represents the entirety of our business. There's no proprietary trading. It's entirely client assets. Of the $6 billion of firm assets, roughly $3.8 billion represents pensions, both public and corporate. Roughly $2 billion, or a third of our money our client money, represents public institutions at the state, sovereign, and municipal level. The Diversified One program represents 1/3 of our assets, roughly $2 billion. And the commingled fund, which we're presenting to you today, represents $1.2 billion of assets across 10 investors, all substantial investments, and all, as we like to look at it, as partners. We're not just managing your money, but in an asset class like commodities, which is not necessarily such a large portion of your asset class, or to many investors, probably outside this room, I mean, given the fact that Oklahoma is rich in natural resources, this is going to be a little closer to your hearts than many of our other investors, but what we serve as is a fiduciary, an educator, and a sort of a conduit for your insight into commodities in terms of, be it market outlook, portfolio holdings, et cetera, and really what's going on in the asset class. Now, in terms of our experience, I've talked about our sole focus on commodities, the decades of experience, and in terms of the team, there's an 11-person investment team. There's been no turnover in the last 3+ years, and the last hire or the last change was really bringing on an additional member. So it's a cohesive group that's been together for a very long time, and as I mentioned earlier, an independent asset manager, which I think sets us apart from many of our competitors. In terms of the actual organization, we're 29 people. which includes 5 people in marketing and investor relations, 11 investment professionals, a full-service middle and back office, in-house finance, and legal. We don't outsource anything. Primarily, or first and foremost, we don't outsource any of the trading. You'll find other managers that might, but in our view, we're trading on behalf of the clients, and we're not trying to show the market either what we're trying to do in terms of signaling to the market, reducing positions, moving within the forward curve, et cetera. But by and large, by keeping all of the execution in-house, we aren't farming out any of the risk or even introducing other risk by means of sort of swaps or over-the-counter instruments, which, as you know, can introduce counterparty risk, among other things. So I think that brief overview of the firm should line up somewhat well with what I gleaned from OSER's IPS, which I looked at online, and obviously hammers home a few things. One, the fiduciary responsibility of OSER's to its constituents, the prudent manner with which you manage the assets, and the risk-return profile. I think a lot of what I'll talk to you about in terms of our product specifically measures both absolute and relative risk attributes relative to the index that you've chosen. If you will, please turn to page 3. This is an overview of the asset class and investments in the asset class. I'm sure other managers will discuss this scenario, and ACG has briefed you in terms of educating you on how this asset class is managed. Now, if you look on the top half of the page, this is really not, this is a cross-section of commodities. There's no cherry picking going on here, but what you notice over the last 10 years, there's been a tremendous price appreciation in the spot price of all of these commodities, between 50 and 250%. But the bottom half of the page represents an investment in an index like the Dow Jones UBS Commodity Index. And that's trailed the price performance of the underlying commodities by a tremendous margin, eating away at really all of those benefits that an institution would glean from investing in the asset class: the inflation protection, the diversification, the risk-return improvement. Now, that's all based on the numbers above the line. So a manager like ourselves is attempting to bridge the gap without introducing extra risk to the portfolio, attempting to add a couple hundred basis points to the investment with a risk profile that will look, as Andrew said, very much like the index. If you turn to page 4, this quantifies the same metrics over different time horizons. If you think about commodities specifically, commodity futures have physical underlying backed commodities. For example, a barrel of crude oil or a bushel of wheat, a bar of gold. And that's very different, say, than pricing or valuing equities, where you're simply discounting cash flows and the present value of those cash flows is deemed to be the price of an equity. In this space, there are no cash flows, there are no dividends, etc. What's really going on is market participants, be it pension funds, mom and pop who's buying an ETF that's 3 times levered, a farmer in the Midwest, or a refiner, anyone who has a view, no matter how they trade or invest, be it through a manager like ourselves, futures, ETFs, etc., all of those views come together in the futures market and dictate over different maturities the shape of the forward curve. That being said, the normal steady state of affairs is one that is upward sloping. So the price should be more expensive in the future. And if you think about it, for example, if you were to spend $100 and buy a barrel of crude oil today, the going price roughly, and hold it for 6 months, and in 6 months that barrel of crude is trading at $110. Well, to sell it, you don't necessarily make the $10 because you had to finance that position. You had to store it, insure it, and ship it. So there's this cost of physical ownership of the underlying good, even if you only held the futures. So that disconnect, or that extra cost, is what differentiates spot price performance, which is what everyone investing in this asset class is seeking, and the physical cost of that ownership. So if you hold that barrel of oil for that 6 months, it might only net you $7. As opposed to buying Apple for $100, if Apple goes from 100 to 110 and you sell it, you made 10%. So that performance gap is what's called in our industry, and we have a lot of jargon, I apologize, negative roll yield. That's all that is. That's just describing the implied cost of physical ownership. And where we come into play is through determining on the forward curve where we believe the portfolio should be positioned without introducing additional risk to mitigate this drag on returns. Now, you will notice a trend over time. Recently, these numbers have come down. That's largely a result of the fact that interest rates are so low, and the financing portion of this equation is a large factor. Now, that's good and bad. Why is it good? It's good for investors like yourselves, anyone who's looking at a long-only investment, because that hurdle to get over, or that gap between spot price and the investable index return, is shrinking. Good for long-only investors, however, potentially limiting for managers who are attempting to bridge that gap, because that is defined as the opportunity set with which we manage the portfolio. So I will say, I can't speak to how other managers operate, but I will say that in the Diversified One program, we aren't targeting a certain level of outperformance. We target specifically a level of tracking error, which is also relative risk to the index. We'll basically look at where the index is trading, the amount of volatility in the index, and say we would like to be 1.5% to 3% of tracking error, and then back into how much outperformance we attempt to glean. Over the 5-year track record of this program, we've generated 200 basis points of outperformance per year on roughly 180 basis points of tracking error. So if you think about it, that's an information ratio in excess of 1, which I think compares favorably to many of our competitors. A tracking error of 180 basis points will be very, very similar to even index replication, which won't be able to generate any outperformance above the index. And when we get to the page in the back of the book with the performance metrics, we're actually realizing volatility a few basis points below the index. So, as I mentioned, very similar to index performance, very similar to index risk profile with a couple hundred extra basis points per annum. If you'll turn to page 5, this is an overview of our investment process. In terms of just the investment philosophy, there are a few bullet points I'd like to share or reiterate. One, we're always 100% invested. We are, in this product, Diversified One, we're just taking a view on the forward curve, whether we want to be in the same position as the index or potentially a longer dated maturity. That being said, we always limit ourselves from a risk perspective to the first 12 months on the forward curve. And that's, again, for liquidity and risk purposes. What we find beyond 12 months is that a lot of these commodities have a trading by appointment sort of concept. There's much less liquidity out there, and the producers and the hedgers are in the nearer term months, and we're not trying to disadvantage the portfolio by taking inordinate amounts of risk relative to the potential payoff for outperformance. Our gross exposure will always equal our net exposure. We're not levering the portfolio. There are no calendar spreads. What you see is what you get. The gross exposure for this product will be, or as of month end, was about 3% above, or 103%. But that's by nature of potentially investing in deferred contracts. We need to adjust to replicate the volatility of the front month or the index. We only trade commodity futures. We're not trading in the over-the-counter market. There is no counterparty risk. We limit ourselves to futures, again, for the liquidity and the fact that we execute everything in-house. The collateral, since commodities are collateralized, collateral is managed very conservatively with cash and 90-day T-bills. The rationale behind that is that the information ratio, which we've been able to generate on the commodity side in excess of 1.0, is not something that we as commodity managers can duplicate in the collateral side, and don't want to detract from the risk-return profile of the product. And then lastly, I mentioned this earlier, I would say risk management will play into our investment process at every stage of the process, which I will get into in a second, but that, like I mentioned, we start with targeted tracking error and back into outperformance, which is to say we don't put on risk for risk's sake. To run into the investment process, and please stop me at any time if there are any questions. The investment process applies across the board for all of our products, all of our strategies. It's a multi-factor approach, bottoms up in nature, and reviews all 22 commodities in the index on a weekly basis. Now, we aren't trading or including commodities in the portfolio that are not already in the index. And this process, this Diversified One program, will rebalance on a monthly basis to the weights, approximate weights of the index. And this reduces tracking error, basis risk, and lowers volatility. What we try to do on an ongoing basis is incorporate 4 different factors into our investment process. In the top left quadrant, something we term quantitative in nature is anything quantifiable in terms of price activity, volatilities of the contracts in the program or under consideration for the program, the correlation between different commodities, the correlation between gold and crude oil. At most times, they'll be uncorrelated. The forward curves will be uncorrelated, which impacts our process. And in terms of an example, if you looked at coffee price movement in the last year, coffee prices plummeted down to $1, and signals at that point were becoming very bullish. I mean, the world as a whole is drinking more coffee, but there was an oversupply coming from South America from 2 harvests ago having experienced a drought. So as you would imagine, there was a correction in the amount of plantings, and then there was an oversupply, and suddenly the price plummeted to $1. Now, our quantitative signals were telling us this was a good time to position the portfolio for a rebound, and we benefited from the price moving back from $1 to $2. Again, just by managing the curves. There's no weighting decision going on in this program. Moving to the next quadrant, the fundamental aspect of our review will review industry sources, government sources, sell-side research, and our own proprietary research. Now, there's no one source that's better than the other, and the truth is what we think our unique approach and value add is that we have the experience and the advantage of being able to call information from different sources and come up with a view. Now, I'm not going to tell you that we're counting the number of bean stalks in the Midwest, although I do have to say after the last meeting in Oklahoma, I did go up to Cushing, and that was actually quite an experience. If you haven't, it's something worth seeing. It's one thing to see the price on the screen and to read about it in the news, but to see the tank farms and to see the pipelines, super interesting, highly recommend it. Anyway, sorry, back to the topic at hand. The fundamental review will review, for example, crude oil. We'll look at the stocks in Cushing and the weekly draw. Of course, every week the DOE comes out with what the inventory levels in Cushing are. Cushing obviously being the central delivery point for WTI crude oil. Our fundamental review will supplement that of the quantitative side and dictate or give us a signal where on the forward curve we want to be positioned. Now, it's our job to mesh these 2 signals. If quantitative measures are saying we want to be in a near-term month and the fundamental review says we want to be in a deferred month, we're going to need to determine what the appropriate positioning is. Now, the market dynamics bottom right quadrant is something that 10 years ago didn't even exist. There was less information out there on the asset class, largely because the asset class didn't have as much institutional money following it. And as you would imagine, as there became more market participants and more institutional investors, the transparency in the marketplace and the amount of information increased. And now the CFTC publishes a report called the Commitment of Traders Report once a week, which says this is the amount of commercial users who are long and commercial users who are short, and this is the amount of non-commercial users. Non-commercial users is a nice way of saying speculators. But the truth is, anyone who is not a producer becomes a speculator. Now, that means investment banks, that means asset managers, that means institutions like yourselves who just want to put a position on in gold, for example. Why that's interesting, if you think about a refiner, right? A gasoline refiner is always on the same side of the ledger. They're always buying forward to lock in their prices. So the commercial length or shortness or participation in this market is relatively stagnant. And on the other side of the ledger, if you're looking at a farmer, he or she is generally selling forward to lock in the price of their crops. Where this metric becomes pertinent for our investment process is that all of the non-commercial users will shift between long and short. And so we look at, on an ongoing basis, what these levels represent in terms of relative to recent highs and lows, relative to all-time highs and lows, and at times, this will be sort of a benign metric, right? But when at extremes, it's extremely telling and can override signals from the other quadrants. For example, 2 years ago, natural gas prices plummeted from $7 down below $2. All of the quantitative signals were very bearish, saying the price is going to continue going down. On the fundamental side, this was coincided with sort of the boom of fracking across the Midwest and the Northeast. And now on that side, you're looking at fundamental supply is coming through the roof, right? Again, an oversupply or abundance of supply would be a bearish signal as well. And what was extremely interesting was this market dynamics bucket or factor. The Commitment of Traders report showed that all of the speculative participants were already short, and it was at an extreme all-time net speculative shortness, which is to say all market participants who weren't always on one side of the ledger had already expressed their view to be short, and that actually dictated or fueled the short covering rally from $2 to $4. So we benefited from that in the Diversified One product by being deferred and being able to sell liquidity to the market, which meant moving our positions to the near term, which then appreciated as the short covering rally happened. And also on more active products of ours I'm not talking about, we were able to benefit from being overweight. So what's interesting about our approach, I believe, is that there's no one factor that's always important. There's no one factor that I would say is more important than another. It's really about how they interact with each other, and we're monitoring all of them at all times. But not to say too frequently. We're not a day trading shop. We're not going to overtrade the portfolio. In actuality, our portfolio turnover is actually slightly less than the index over the 5-year history. So we're rather proud of the ability to generate the outperformance we've been able to without overtrading the portfolio. Now, the last bucket is something we deem manager discretion. That's a catch-all for, look, we've been trading these markets for over 2 decades, and you would think that amount of experience might lead us to be more cavalier in our risk approach or take on additional risk, and I would say it's exactly the opposite. This is an asset class where if you look at the names and the participants, in the long-only space, and to a greater extent the long-short space, you'll notice the names of 5 years ago or even 5 months ago change on an ongoing basis. Managers in this space blow up more often than any other asset class, which is why we take it so seriously that we really are stewards of your capital. There's nothing more important than sort of maintaining the relationship and the opportunity to make it a long and lasting relationship. So this bucket incorporates scenarios and events in the marketplace we haven't seen before or things we have seen and we want, generally speaking, to tamp down risk. This is, in the 5 years of managing the product, has never turned into our portfolio saying, I want to override the model or override the team. This has, generally speaking, been an opportunity to reduce risk, for example, during the Arab Spring of 2 years ago and that impact on crude oil prices. Or even this morning, obviously, we saw the news coming out of Portugal, which led to a 2% increase in the spot price of gold and silver. Opportunities like this for the manager to say, we need to reposition our portfolio, whatever the model's going to say or the fundamental research, there's a dislocation in the marketplace. Right now, the market's acting on fear. It's not acting on fundamentals, and it's not acting on quantitative. It's not that suddenly there's a shortage in gold, right? It's really, oh, there might be a flight to safety. It's opportunities like this that we take to reduce risk. And when I say risk, we look at tracking error relative to the index. We look at the volatility of the program versus all of the components in the index and the index at large. And we look at tail risk, again, because commodities are an asset class where tail risk is relatively important. And being mindful of the time and wrapping it up shortly, if you would please turn to page 11. I believe that ACG has gone through our performance metrics with you. I'd like to highlight a couple of statistics that may or may not have come across already. On the top band, the bottom right says frequency of monthly outperformance. Really what that is a batting average. How frequently do we outperform the index? Over the 5 years, it's been just under 75% of the time. 3 out of every 4 months, we're improving on the index. And I think that speaks to the process that we've created, the reproducibility of the process, and the consistency. We're not trying to outperform by 2% in 1 month and then lock in that and sit tight for a year. We're also not trying to hit home runs. We're really trying to hit a lot of singles. Sorry, excuse my analogy. But at the same time, the beta to the benchmark is 99%. The correlation to the benchmark is 99%. Everything looks like an investment in the index, but the ability to generate outperformance consistently, and that's summed to 2% per year. Every year, if we can add 2%, or if you could add 2% to each one of your asset classes, I think everyone would agree that'd be a pretty great deal. That being said, the tracking error is sub 2%, and that generates an information ratio of, at this point, 1.13. I think that'll compare well against all of your other contemplated managers. Now, again, as an enhanced index type of product, I'm sure that they will show you numbers with higher outperformance, but I do think our information ratio, which is risk adjusted, should look favorably. In terms of how we add value, I think our ability to process info, which I mentioned earlier, we look at investors as partners in terms of educational seminars, meetings with the board, which we meet with each investor at least once a year, more frequently if needed, and also are happy to schedule tutorials via conference calls to talk about portfolio holdings or market outlook or educational in nature. Again, we're dealing with commodity futures on a daily basis. That's not necessarily true of many of our investors. And also transparency. I think we take it very seriously that even an investor in our fund is welcome to see what we're doing. On a monthly basis, our standard operating procedure is to generate portfolio holdings, so you'll know where the current exposure is, what we've done over the course of the month, what's done well, what hasn't done well, and also sort of further analysis on relative performance from one sector to another. I'd like to just, in closing, say that I believe you're looking at a fund, a commingled fund. We also would offer a managed account if that is to your preference, which obviously would give you daily liquidity. In actuality, our commingled fund, which strikes an NAV at month end, also has a feature. Investors are welcome to redeem on 1 day's notice up to twice per calendar year. So in essence, while it is a commingled fund, it has this daily liquidity feature. Not that you're trading in and out of the program, but it's nice, and it was instituted for another ERISA client. So it's available to everyone in the fund. I think you have our fee arrangements to the extent that you were looking for another fee alternative. We're certainly welcome to work with you in terms of lowering a fixed fee and changing the participation if that's a consideration. If not, I think that pretty much wraps it up. Hopefully I've been able to leave you with an idea of our experience, the cohesion of the team, the consistent approach, reproducibility of the program, and a very risk-measured format. Again, if there are any questions, I know I'm pretty much out of time. But
any board member have any questions?
Happy to answer.
Randy, do you have a question?
I just have one, and I'm sorry if I missed this, and probably everyone up here understands this, but I need some help on the I understand what correlation is, I understand what beta is, but what is exactly this correlation about performance to beta, and what does that mean to us?
Thank you. So the correlation of outperformance to beta is to run a correlation of the outperformance or the alpha generated. So if we beat the index by 20 bips this month and 20 bips next month and then underperform by 10 bips, we run a correlation of that stream of data or performance to the movement of the index. And why that's telling, first of all, at negative 15%, it's statistically uncorrelated, right? I think everyone would probably agree. Why that's telling is that when we move our positioning outside of the contract, the index month to a deferred position, what we do, what we did if we didn't correct for that would be introducing a negative beta. And I say that because this will take 60 seconds. Again, I apologize for the time. If you please turn to page 6. On the left-hand side, you see a forward curve that is in contango. Really, that just means that the physical cost of ownership, which we talked about earlier, means going further out on the forward curve, contracts become more expensive. And on the right, this is a plot of the same contracts and the volatility of each. Further out on the curve, the contracts become less volatile. So if we were to say buy $100, the index said to buy $100 of crude oil, and we wanted to defer the position in the portfolio 6 months, we would be buying, if we spent $100, a more expensive contract that's less volatile. So we would in fact we would have less beta than the index. What we do to correct that is we have a proprietary way of measuring the beta of contracts further out so that we can adjust the number we buy when we defer a position to mimic the volatility of the index. By doing that, we've been able to create a product where those decisions to move into more deferred months is uncorrelated to the market direction. Whereas to say, if we didn't introduce this, if we didn't have this hedge ratio in place, every time we moved our contracts further out and then the market shot up, which is when you want your portfolio to be protected, those contracts further out would underperform. And in the other direction, if we were deferred and we didn't have the hedge ratio and the market went down, you would outperform. So that's the sort of the negative beta that's in play. And exactly when you want your portfolio to have the protection for when commodity prices, there's a shock to commodity prices and they go up, if you're in a deferred contract month, you don't want to be disadvantaged for not having made that adjustment. And I think if other managers don't report that, they certainly don't report that metric, they certainly aren't doing what we're doing. Hopefully that helps.
Any other question? If not, thank you, sir.
All right.
Appreciate it.
Appreciate your time, W.
All right.
WB, and everyone else. Enjoy the day.
So last but certainly not least, John Berlin from Gresham.
Good morning, sir. You got 30 minutes and you're on.
Thank you very much. Good morning. I'm John Berland from Gresham Investment Management. Thank you very much for the invitation to be back in Oklahoma City. As I said when I was here a few weeks ago, if you don't like Oklahoma City, you don't like commodities, because there's very few other airports where when you come out, you got a pump jack right on the right there. So this is a great town for commodities with a very long history, and that's important to a firm like ours because we have a singular focus, and that is commodities. That's all we do. We manage $15 billion that is focused entirely in commodity strategies. We've been at this for a considerable amount of time, as you may have seen, in going through our materials. Our longest-running program, the one we'll be focusing on today, has a 27-year track record. We began in 1987, and as you'll see, it's somewhat unusual in the asset management space. Our track record actually predates the creation of the benchmarks that we're now measured against. We're based in New York, 54 people, 19 investment professionals, and our team has been working together for a very long time. We think that's important. We look to add talent where we can, but we have a nucleus of portfolio management and other experts who have been doing this together as part of the team and therefore been responsible for producing the track record that you're seeing, all at Gresham, all working together. As you'll see, too, we manage for a very diverse group of clients. Our client base includes 7 different state retirement systems. I'm pleased to say that here in the state of Oklahoma, we actually count OU as an investor. They've been with us for a number of years. We've also recently won a mandate from the Oklahoma Police Pension and Retirement System that's expected to fund at the end of this month. And we were also recently ranked again the #1 commodities manager by Pensions and Investments. So what I'd like to do today is just take you through some snapshots of our history so you can understand how we began our work in this space and really use that as a launching point to delve into our philosophy, how we think about managing a portfolio of commodities. And once you understand what we are intending the commodities to do, focus on 2 areas in particular: our investment process, and also our risk management. And I'll take you through some illustrations of that, and I would encourage you at any point along the way, if you have questions, please feel free to jump in, or I'm happy to take them at the end as you prefer. So just turning to page 4, you have a quick snapshot here of our client base. As you'll see, half of the assets of the $15 billion that we manage are for pension and retirement funds. And this, to a large extent, informs our approach to managing in this space, because we take a fundamentally conservative view when it comes to constructing a portfolio, investing the portfolio, and risk managing the portfolio, because those assets are not easy for the people who are contributing them to replace. And so we think that an extra degree of prudence is called for in thinking about how do you intelligently construct a commodities program that can be reasonably expected to deliver the intended result. And I think that you'll see that as well in our track record, a great deal of stability in the results that we've produced. I mentioned that I would give you a little background on ourselves and our history and how we came to be involved in this space. If you turn to page 5, you have a snapshot of our organization. Our founder and chairman is a gentleman by the name of Henry Jarecki. Henry is a luminary in the commodity markets. At one time, he ran the largest bullion dealer in the world. And he had the very good fortune to have his partner in that business, Standard Chartered Bank, ask to buy him out. And that's a high-class problem, because when somebody wants to write you a check with a lot of numbers, what do you do with all that money? Now, Henry was already a believer in modern portfolio theory, so he's going to have some stocks, he's going to have some bonds, but thinking about this in the early 1980s, what troubled him is that if you looked over the past 25, 30 years, neither stocks or bonds by themselves or in combination have done particularly well. And he had this notion at that time that adding an allocation of commodities to his portfolio would produce an equity-like return with an equity-like level of volatility on their own, provide a non-correlated source of return relative to the other assets, and, in particular, provide an outstanding hedge against inflation. The hitch, though, thinking about this in the early to mid-1980s, is there was no way to evaluate that idea. There was no commodity portfolio out there that you could go and look at the historical performance of. There was certainly nothing that you could invest in. And so rather than being discouraged by that, we hired a bunch of kids, sent them to the New York City Public Library on 42nd Street, had them go and get newspapers, microfilm, microfiche of daily newspapers back to 1960, copying out from each day's newspaper the closing commodity prices, coming back to the office, typing them in the best technology of the day, that big computer, right, spitting out the output on the punch paper, and we built up a history of a diversified commodity portfolio from 1960 to 1985. What did we see? Equity-like return, equity-like risk, outstanding correlation and beta to inflation. And we had enough confidence in this idea that in January of 1987, we put Henry's money to work. And we've been doing this ever since. And that's the origin of the TAP program that we're talking about today. TAP stands for Tangible Asset Program. And the tangible was to differentiate this from other types of commodity futures that you're probably familiar with, financial index futures or interest rate futures or currency futures, none of which are part of this program. So what we've done since we started, if you look at page 6, gives you a snapshot of not just when we began, which was 1987, but also the benchmarks that came along afterwards. So 4 years later, along came the Goldman Sachs Commodity Index. A dozen years later, along came the Dow Jones UBS Commodity Index. And when you look across the common period, which you see in the box on top, we've handily outperformed both of what are now considered to be the benchmarks in this space. We've also delivered on our intended investment objective of producing an investment that hedges against inflation. And page 7 clearly shows you TAP's correlation to CPI versus other types of real assets and financial assets. So very high correlation to inflation, 0.58. The period that we've taken here is actually since the inception of the TIPS market in the U.S., because we know a lot of people think of TIPS as being an inflation hedge. When you actually look, though, since the launch of TIPS at their correlation to inflation, Not very impressive, only about 0.2. So what we're doing is produce 3 times the correlation to inflation of TIPS. And very importantly, if you look to the right of that green bar showing TAP, you see what long-short commodity strategies do. And I make this differentiation because we manage both types of commodity portfolios. We manage long-only portfolios, and we manage long-short portfolios. And to us, it's important not to mix the two, because the last thing that we want to do is produce a cat that barks. And when you look at what a long-short commodity program does, it can produce an attractive return, but you lose a great deal of that inflation protection. And that's what this is showing you. You see it also on the next page. Because we think what's important is not only to think about the correlation to inflation, but the beta to inflation. Because for most of our investors, their investment in commodities with us is a relatively small portion of their portfolio. So it's very important to think about how that portion of their portfolio is going to pack some punch for the pound as a hedge against inflation. And what you see here is that TAP's beta to inflation has been over 3.5. That's 25% higher than the Dow Jones UBS benchmark. It's 3 times the amount of the long-short commodity portfolio that we were talking about. And if you look all the way on the left there, you'll see it's about 9 times the beta to inflation of TIPS. So here's something that has really worked as an inflation hedge, where at even a relatively low allocation, you get a high correlation to inflation and, very importantly, a high beta to inflation. We also think this is a great time to be talking about initiating commodities investments, because when you look at our 27 years of history, what we found is that TAP has done very well during periods of Fed tightening. And I'm not ready to stand here and call a taper a tighten just yet. Right? Fed's still printing a great deal of money. But clearly they're on a path to winding down, and then if you believe Chairwoman Yellen's remarks, it may be as near as 6 months thereafter that we could actually see the Fed start to tighten. Well, when we went back and we looked at every instance of Fed tightening, in the time that we've been managing TAP, we've been through 4 Fed tightening periods. In every one of those 4, TAP outperformed bonds. That's not a big surprise. In every one of those 4, TAP also outperformed equities. And in 3 of the 4, we outperformed the S&P 500 by more than 1,000 basis points. So we think that we're entering a very favorable period for commodities investments, particularly doing it with TAP. So turning to TAP in particular, as I mentioned, I wanted to dive into our investment process next. And what we're discussing here is a broadly diversified and unleveraged commodity exposure. We have excellent liquidity. We can give you either daily liquidity or monthly liquidity as you prefer. We have a very conservative approach to collateral management. We know there are strategies out there where the collateral that's backing the commodities is sometimes used as a honeypot to reach for yield. Well, we're not interested in doing that. We think that you want a commodities manager and you have enough fixed income managers to handle your fixed income investments for you. Everything we invest in is traded on an exchange, so they're all level 1 holdings. And even though you are not technically an ERISA plan, we manage to an ERISA standard. So you get extra levels of care and prudence because we're managing for ERISA investors as well, and the whole fund is managed that way. I'd like to turn to page 11 now and really focus on the investment process. And when we think about investing in commodities, there are 2 principal questions that we have to answer. One is, what do we own? Which commodities do we invest in? How much do we allocate to them? The second question, which I'll come to in a few moments, is how do we own them? But to the question of what we're going to own, there is a common truth across the commodity markets in which we can invest. And that is that they are characterized by fundamental uncertainty. There is uncertainty around either the supply of those commodities, or there is uncertainty around the demand for those commodities, or both the supply and the demand. But when uncertainty disappears, it means that you will no longer find a liquid futures market, because commodity futures markets exist for risk transference. It's because I'm raising a cattle And I don't know what prices are going to be in the future, and I want to make sure that I can achieve a certain return on my investment. So I hedge my risk by selling a contract forward, right? Or on the flip side, I'm running an airline, and I know that jet fuel is a major component of my expense base. I want to hedge my costs for buying fuel forward, so I can instead focus on how many planes I want to lease, where I want to set up my hubs, and other parts of my business strategy. But I don't want to take commodity price risk. So the only markets where you'll find that type of hedging interest is where you have uncertainty. Uncertainty around supply, uncertainty around demand, or uncertainty around both supply and demand. Because without it, you're not going to have liquidity in a futures market. But that means something very important. It means that there is no way to use fundamental measures of value to determine whether any given commodity is cheap or expensive. There's no price-earnings ratio. There's no market capitalization. There's no yield to maturity. There are no cash flows. None of the things that you would look to your managers in other asset classes to do to determine whether something is cheap or expensive will work in this space. The only thing that we've found that works is momentum. But when you go with momentum and you start looking at using that, that's when you think about long-short and you lose the inflation protection. And that's why we keep them separate. So instead, what we found is if you want the inflation-protecting benefit of commodities, you want to think about constructing a portfolio that accounts for their relevance. What is the importance of each of these commodities around the world, and how might that change over time? So we have a research team as part of our organization that is looking at a universe currently of 57 different commodities. And from those 57, they have selected the most relevant and investable contracts to be part of our portfolio. So we currently have 31 different commodities in the portfolio. That compares to 22 in the benchmark, because we think there are additional important and relevant commodity markets at the benchmark, frankly, because they don't have a research team dedicated to it, have been slow to adapt and bring into their portfolio. And generally, we've been very successful over the years in bringing commodities into the portfolio before the benchmark has done so. A major example I would point to would be our decision to bring Brent crude oil into the portfolio 5 years before the benchmark did, as things were changing at Cushing. And I'm sure just given my virtual location, you're very familiar with what's been going on there. So the next thing that we do as we think about constructing this portfolio is that we also force diversification through it. Because if you don't force diversification and you're looking at measures of importance, you could end up with a portfolio that's tilted or skewed to one sector or to particular commodities. And when you allow that to happen in the portfolio, that's when the volatility of your portfolio starts ticking up. Because again, there's never been a Warren Buffett out there who can tell you that this commodity is going to be going up or that commodity is going down, in other words, looking for deep value. So given that uncertainty, if you allow yourself to be overexposed to a given commodity, you might be in for some very nasty surprises. So we force diversification at multiple levels in the portfolio. We don't allow the largest sector to be more than 35% of the portfolio. We don't allow the largest two sectors to be more than 60%. We don't allow any commodity to be more than 70% of a given sector. We will not allow a complex. When you think about a complex, I'm talking about soybeans, right? You take beans and we trade that market, but you also have bean oil and bean meal. And that's the soybean complex. We won't allow them to be more than a certain percentage of the portfolio. And when you put all those rules together and you look at what we've achieved, there's a lot of people out there who I think have a bias that they think of commodities as being a riskier investment than many other things. Well, that's because, their brother-in-law or somebody else took a flyer on pork bellies and lost his shirt. But when you look at what we've done over 27 years, our realized volatility has actually been less than the S&P 500. So we're managing a commodities program here with TAP that's less risky than just owning U.S. stocks. We end up investing across 6 different sectors: energy, industrial metals, base metals, agriculture, livestock, and what we call foods and fibers, or softs, so cotton, sugar, cocoa. And the factors that we look at every year to determine what our weighting is going to be are global trade, global production, and futures liquidity. Differently than the benchmark, we only think that global liquidity is a third as important of the whole portfolio compared to the other factors. When you look at the Dow Jones UBS benchmark, they have liquidity as being 2/3 of their weighting decision. The result is that they end up with a lot of exposure to weather beta. Because when you have weather events, right, tremendous cold, like a polar vortex this past winter, or tremendous heat and dry weather during a planting season, that will drive hedging activity. But what we've seen is, on average and over time, investors are not compensated for weather beta. It creates additional volatility with no real return that accompanies it. So that's led us to think about how can we construct the portfolio more intelligently, and we use a different weighting process than the benchmark. The commonality that you see if you look at TAP on the left and Dow Jones UBS on the right is that they too are forcing diversification. The fellows who created that index actually met with us before they got started, and I think they took away some of our good ideas and they went right on from there. But we're not content to stay static in our approach. And what you see on page 12 is how, through our research work, that portfolio construction has evolved over time. And this is one of the ways in which we look to add value by evolving, through our research work, the portfolio construction over time. So if you look at page 13, you see the allocations that we had in place in the portfolio at the beginning of this year. What I would like to call out to you, which leads to the second way in which we add value, is that if you look at this table on page 13, you'll see that there are a number of markets in which we have exposure to a commodity on more than one exchange. So I talked about Brent earlier. Well, we have a choice that we can make. We can own crude oil as either Brent or as TI. We can own coffee as the Arabica coffee contract or the Robusta coffee contract. Wheat's actually traded in 3 places: Kansas City, Chicago, and Minneapolis. And one of the things that we've found we can do to create value is at times identify where there's an arbitrage opportunity between 2 different markets for the same underlying commodity. And what we will do is we will tilt the portfolio at times and its exposure to a given commodity between those 2 or 3 markets. So what we're never going to do, to be very clear, we're never going to look at crude oil versus cocoa and say, I've been eating a lot of Hershey's lately, so I think we should go out and buy some more cocoa and buy a little less crude oil, because there's no way to make a price comparison between crude oil and cocoa. But when we think about crude and we think about what might be happening in certain parts of the world or in storage levels at Cushing at a given point in time, that might indicate to us whether we'd rather hold more of our crude oil position in the form of WTI or in the form of Brent. And so active exchange tilts are one of the ways in which we add value. And you see an illustration of that on page 15. Page 15 takes you to a trade where you had some shocks. This is the beginning of the shocks that we saw to Middle East production. And we made the decision, without changing our crude oil weighting at all, to tilt more of our crude to Brent rather than TI. And what you see is, over this period, both Brent and WTI appreciated. But our Brent holdings went up 3.4%. The WTI holdings went up 30 basis points. So the additional amount that we added to Brent added another 300 basis points of value over this 4-month period to the returns. What I want to turn to now, though, is really the core of what we do, and that's active implementation. This is how we focus on making money every single day. How we own commodities is critical, because I'll go back to what I said earlier. We don't think that you can look at 2 different contracts like cocoa and crude or nickel and corn and say that one is cheap or expensive relative to another. But what we can do is, every day when we come into the office, we have a choice of how we're going to own that position and in which contract month we want to invest. Do we think there's better value in an old crop corn contract or a new crop corn contract? Would we rather own prompt natural gas, or would we rather own natural gas looking out to the shoulder season, getting between next winter and next spring? And what we find is that there are regular dislocations in the commodity futures curve that actually present opportunities for us to add value. That's where we can buy low and sell high. Because if you think about it, right, there's different views of what a commodity futures curve should look like. Keynes' idea back in the day is that commodity futures curve should naturally be downward sloping. Backwardation is what that's called. Because in Keynes' time, farmers were generally speaking so small and so poor that if they wanted to guarantee their family's livelihood to the next season, they would gladly be willing to sell their crop forward for less than it was being priced on the market today, because it was essentially an insurance function for them. In today's day and age, as we talked about, for example, airliners and other types of producers, commodity prices are such a risk to them that they are glad to pay up out the futures curve. And so you also see upward sloping futures curves, contangoed curves. What we find is that there's a great deal of volatility in that term structure, that shape of the commodity futures curve between backwardation and contango. And that gives us the opportunity to take advantage of that volatility and even to identify where there may be bumps or divots where something's mismarked. Well, how do we identify this? The first thing we do is we look at what's observable. When you look at the commodity futures curve, does it look like there are contracts that are overpriced or undervalued? And we have cost to carry models that we maintain internally that give us a sense of what that curve should look like if it was fairly priced. But that's not enough, because the second angle of analysis that we have to pursue in this multi-factor approach is to really dive into the fundamentals. What do we know is going on in a given market? And those fundamentals will differ a great deal from one market to the next, right? Obviously, if I'm looking at crude oil, I'm very interested in refinery run rates. If I'm looking at soybeans, I've got no interest in refinery run rates, but I am very interested in soil moisture conditions. Right? And so we look at sets of fundamental factors in each given market, each of the 31 markets that we're trading, that also can do two things. One, either they validate that there's a mismarking in the term structure, or they can identify opportunities that haven't presented themselves yet. But that's not enough. The third angle of analysis that we pursue is that of very experienced practitioners. We've been doing this now for over a quarter of a century. And therefore, we know that there are trading dynamics to these markets too as we're investing. And that's an important part of our investment thinking. What do we know about resistance levels or support levels? What do we know about certain types of technical triggers? And this becomes very important as well from a risk management standpoint. Because if you don't take those factors into consideration, you can have a wonderful theoretical understanding of the world, but the practical reality may be very different than what you're thinking. And the last part of this process is execution. Because the truth is, we like everything at the right price. And at the wrong price, we just as soon be patient. So we don't just place trades and hand them off to a trading desk to do it. We watch them. We work them. And if it means we have to work a trade over a period of days, we'll do that. We're happy to scale into something, and I'll show you an illustration of this. On the other hand, if we think there's an instantaneous opportunity, we'll jump on it. And that execution is a key part of how we add and preserve value for our investors. So just on page 18, you have some snapshots of one market, some of the market-specific analysis that we do. And again, this is just crude oil, so you can see the factors we're looking at. Obviously, if we were looking at another commodity market, you'd see very different factors that we would be considering. But the key in all of this, as you see on page 19, is that you just can't expect things that have worked in the past or something that you think is seasonal or somehow fundamental to repeat or persist, because it's like to say history repeats until it doesn't. And you have a representation of that here. This is looking at, again, a natural gas spread that's known as the Widowmaker, with good reason. This is the March-April spread, which is the end of winter. and the beginning of spring, when usually you see a big shift in demand. And you tell me what this spread should naturally look like. Does it look like these very calm green and blue lines here down at the bottom? Or does it look like the darker red line, which was the coldest winter that we had in the U.S. before this past one? Or is it the bright red line, and that's the year that Amaranth blew up? So understanding that these factors can change and that you cannot simply rely on past quantitative analysis or back testing to inform your trading decisions is a critical part of how you add value. Well, let me show you two real examples quickly. The first one on page 20 is actually looking at corn. And we had questions, this is last year, around how much corn was going to be harvested around the September time frame. Because last year, if you remember, there was a lot of rain through the Midwest, and that pushed plantings to a late date. And the question was going to be, what would corn supplies be like before you got the bulk of the new crop delivered into the December contract? So it was going to be available in September. Well, we speak to farmers all the time, and our intelligence was telling us that there would in fact be a fair amount of corn to be had as early as September. But we realized that there could be volatility around this. And so each of these green dots that you see on this chart is where we made a buy. And you see we start scaling into this at 20 cents, 40 cents, looking at selling our September holdings high and buying December contracts cheap. And we work these trades at 20 cents all the way up to 30 cents, and we actually get it off as high as I think it was 43 cents. And by the time you got to July 22nd, we had 2/3 of the portfolio's corn exposure in the new crop December contract. Well, at that point, you got a USDA report out that confirmed there would be plenty of corn to be had, and this spread collapsed by the end of July. And what you see is that over this time period, we outperformed on our corn holdings by 300 basis points. So not only did we shield the portfolio against a significant loss, we added 300 basis points in the process. That's an example of, again, scaling into something and actively working on a trade over a period of months. What I'd like to show you now is something that happened in the span of a morning. Last October, we got word that there was a fire at the Brazilian port of Santos. Santos is Brazil's largest export port. And facilities owned by Copersucar, which is a very large sugar producer in Brazil, were burning. Not only was the sugar burning, the warehouses, but the loading facilities were also on fire. And so we immediately had to assess that situation. First, how much sugar was burning? Massive quantity. The market had spiked on that news. A drop in the bucket of Brazil's total sugar production. Brazil is a massive producer of sugar. The question to us that was more interesting is, were those loading terminals going to be impaired? Because if that would take a long time to fix, then no sugar is getting out of Brazil. Well, again, our sources in Brazil came back to us and confirmed that those facilities would be operational again by the end of that week, certainly the next. And that, to us, confirmed an opportunity to sell something high and buy low. And we began placing orders in that morning at levels that we thought were ridiculous, simply selling the front month contract, buying the next active contract. We got filled 7% at 30 cents, 7% at 34 cents, another 7% at 39 cents, 5% at 40 cents. And within several days, you see this spike just recedes and goes back to around where it was. So for 2 hours of work on an October morning, we added 30 basis points to return on the sugar holdings. And we find opportunities like this continuously. We never know in which markets they're going to present themselves from one year to the next. This year, we're up over 1,000 basis points in lean hogs, right? But we will continuously be able to identify these types of dislocations market by market across the 31 markets in the portfolio that we can take advantage of. And what lets us do this successfully and repeatedly over time, because that's what's important to us, is the consistency, is that we are immersed in these markets. We live, breathe, eat, and sleep commodities. And we're continuously gathering information and assembling it into a mosaic that helps us make these decisions. The other thing that we have going for us is that we have a proprietary database with our 27 years of trades, market by market, contract by contract. And I appreciate that in an age of Bloomberg, that sounds very simplistic. What do you mean you have data? Doesn't everybody have data? Well, everybody can go out and buy tick data, but what they don't know is that if you lined up those ticks, could you have actually executed at the implied level? And we know the levels at which we've traded for 27 years. And we can go back and find comparable types of situations in time that help us identify when is something actually good value and when should we perhaps be a little more patient. It's almost like a farmer's almanac that sits on the desk of our portfolio managers. Let me caveat what I've just said, which is that as focused and I believe intelligent in these markets as we are, I think that one of the greatest contributors to our success and longevity is our risk management and all the things that we don't do. We don't apply any leverage in our portfolios. We never punt on commodity weights or direction. We have excellent liquidity because we give our investors liquidity, which means that we have to be invested to be liquid and be able to get out at any moment. Everything that we're investing in is traded on exchange, and therefore there's no questions about valuation. And as I mentioned earlier, we're also not trying to get cute with the collateral. We've seen other people who, frankly, I believe are just as smart as we are, but they're trying to do more than the market's going to give them. And it ends up like picking up nickels in front of a steamroller. So a key part to our success and longevity are the very strong risk controls and the work that our risk committee does, of which I'm part, throughout the year. When you look at the success that we've produced on the following page, you see that consistency. In the last 1 year, we're up 170 basis points over the benchmark. Last 3 years, 200 basis points. Last 5 years, annualized, 264. Last 10 years, 170 again. Right. Very high degree of consistency in outperforming. And that's important to us because of the clients that we serve and what they're depending on us to do for them. If a manager goes bust, the people there can leave and go and find new jobs. If a fund goes bust, you can't go out and find a new pension. So we think that it's beholden upon us to invest with a very high degree of conservatism and responsibility, which can still produce what we consider to be very attractive returns in terms of value added. On a monthly basis, we provide you a client statement as well as a customized performance report. We'll also give you a year in review and independent fund audit, and we certainly welcome the opportunity whenever you or your consultant would like to speak with us and just dive into more given market or given set of conditions in the world. That's what we enjoy talking about. So the advantages that we bring to you are a team that's been working together for 27 years. We've produced the longest track record of anybody in this space, highly superior risk-adjusted returns. We've proven that we can generate alpha, and we're always looking for new ways to do that. And we do that in the context of a lower risk investment process. So thank you very much for your time. As I mentioned, I think that this is an outstanding point to be initiating to or upgrading your commodities investments. A number of secular factors in the world that make this a compelling period to be adding commodities. We see a rising world population. We see that there is increased demand and changing standards of living. So you look at the cocoa market in particular, growth in consumption there. And there's also much more politicization around how commodities are being produced. All three of these secular drivers are making the higher levels of demand and higher production floors for getting additional supply into the market. At the same time, when I look at the current context for initiating investment in this space, I see two things that are very promising and I think actually springboard off of the compelling secular drivers that have been around for a longer period. First is that we're entering a new age of energy instability. If there's any question now about what's happening in Iraq and what the risk is if that spreads and we end up with an Afghanistan-like situation, Iraq has been one of the greatest success stories in incremental supply coming onto the market in the last number of years. The parallel story is you need only to look at Libya, which since the overthrow of the government there in 2011 went from being a producer of 1.7 million barrels a day of very high-grade light sweet crude oil to now, on a good day, getting out 250,000 barrels. Right? Once that supply is disrupted because of internal fighting, other types of instability, unwillingness by external investors to put their capital into the country, it's very hard to recover. Second thing, as I mentioned, is in terms of the monetary policy environment. Historically, we've done tremendously well during periods of Fed tightening, and it certainly looks like once the taper comes to a conclusion, that's what will be to follow. So, thank you very much.
Thank you. Any questions from any board members? If not, thank you very much, sir.
Thank you.
Andrew, do you have anything you want to present to us about the three of them?
I think we should just kind of make it an open discussion. There's a lot of commodities there. First and foremost, we are very comfortable with all three of these managers. Our research group, the commodities research group in particular, within our research group has done a lot of work on this in the last few months. Gresham and Blackstone, we have common clients with, other clients with. We do not with Core Commodities, but that's not to say that we don't like them. So really the takeaway here is there's not a bad decision out of the three of these managers. They've done a lot of work on this.
You have a recommendation?
I think that the best way to look at it really is, so you're taking your first dive into this space. In my mind, 100% long-only exposure. It's a small chunk. It's 5% of the portfolio, 30 and some change million. I think a long-only approach would be best, and maybe get a little bit more opportunistic down the road as the portfolio goes. So that's obviously a hit against Blackstone. I think the thoroughbred track record of Gresham and what they've done, and they do something similar to Core Commodities, but it's a little bit more opportunistic, a little more juice is certainly attractive with Gresham. If I had to make a recommendation, I would lean towards Gresham, but again, it's sort of a sense of comfort type situation here, where if you want more, less tracking error, a little less juice, Core Commodities is certainly a good solution. And then if you want to go farther out on the risk spectrum, Blackstone is a solid option as well. So all are fairly liquid, monthly liquidity, all the comparable fees, vehicle-wise. We're completely comfortable with all three. So.
If we chose Gresham, the monthly or the daily?
We would do the commingled fund. The daily would be a separate account structure. So I think the commingled fund, just from an administrative point, would be preferable. They have actually Gresham's just a flat fee. They don't have a performance-based fee. The other two do have an option of performance-based versus flat fee.
Well, in my opinion, Blackstone's a pretty good-sized firm. I mean, they are into everything. I don't know. Maybe they're too big for us. I don't know that. Yeah, but right, I'm not sure about them. So it really comes down to the next two, whichever one you're all comfortable with. All right. What's the pleasure? Yes, sir. Motion been made. Are there a second? Second. All those in favor, signify.
You have a question, Dave?
I do.
Oh, yes, sir. Go right ahead.
I'd like to hear a little bit more about Gresham's fee, and that there's no performance incentives in their fee.
One more time, I'm sorry.
I'd like to hear a little bit more about Gresham's fee, and that there's no performance incentives in their fee.
Yeah, we can certainly talk to them about that as well. I'm sure they have an option. They just didn't state it to us. Their fee right now, their stated fee is a flat fee. It would be 75 basis points on the entire investment. That compares to a flat fee that Core Commodity would offer of 115 basis points with no performance fee. And with Blackstone, the flat fee would be 100 basis points. So it's a cheap flat fee in the grand scheme of things compared to the other two. If the performance fee is something that you like, I'm sure they've done it with clients. I don't know that for a fact, but it's something that we could talk to them about.
What would be your recommendation on that?
We're fine with the flat fee just because it's so low. So a lot of times if we had a fee here that was 100, 110 basis points, we would want to go the performance route. So with Blackstone and Core Commodity, I would recommend the performance fee just because the flat fee is so much higher. But Gresham's very attractively priced for the flat fee, so it's not a concern.
That answers my question. Thank you.
Okay.
All right. Any other questions? If not, all those in favor? Aye. Any opposed? Nobody opposed? All right, ayes have it. Okay. Item 13. Oh, whoa, excuse me, I apologize. 12, discuss and authorize the audit contract for BDK for the annual audit fiscal year July 1, 2013 through June 30, 2014. And then the...
Can we do both of them together?
No, we'll do them separate. Okay. Motion been made. Are there a second?
Second.
All those in favor signify by aye.
Aye.
Opposed, same sign. Ayes have it. B is the budget. You have the budget in your packet. Any questions on it? We can amend it any time during the year, so if something comes up. Anybody got any questions on it? Any questions? No questions? Entertain a motion? Motion been made and seconded. All those in favor signify by aye.
Aye.
Opposed, same sign. Ayes have it. Now I'm back to 13. Jump the gun. You got any?
Yeah, we can do that real quick.
You want to go over the ASAP report for us right quick and?
I'll be very, very brief. In August, we'll have the full quarterly report, so we'll take a deeper dive there, and we've been here for a while. Did Jason present the new format to you last month?
Yes.
Okay. So yeah, it's a lot cleaner. On the front page, you can see the allocations, and we've kind of composited everything on the second page, and then more detail in the third with the underlying managers. Big picture really quick, kind of a mixed bag in the U.S. economy recently. Downward revision, big-time downward revision on GDP in the first quarter was revised to negative 3%. So negative 3% growth in the first quarter is obviously a pretty big downturn. That's on one hand. On the other hand, the employment picture really continues to brighten in the United States. 288,000 new jobs were added in June. That brought the unemployment rate down from 6.3% to 6.1%. So clearly some pretty good news there. The last 6 months, so essentially year to date in 2014, the most jobs have been added during that 6 months than any other 6-month period dating back to 2006. So despite the poor first quarter, most economists are generally positive rather than negative just because of that job growth, and they think that'll translate into continued production. And on top of that, the stock market has performed well. It's continuing to hit record highs, so it's something to certainly watch. But it's been positive news nonetheless. On the financial markets front, again, stocks advanced in the second quarter. U.S. stocks outperformed large cap stocks. This is just the second quarter. That's a nice rebound to see. U.S. small cap stocks struggled in the first quarter, so they had a good rebound in the second quarter here. And then U.S. as a whole outperformed non-U.S. in the second quarter.
Question on jobs. Aren't the jobs lower paying jobs, though?
Actually, this was an interesting, I had that intuition as well. I was watching the news yesterday. I read it in the journal, actually. I think it was 58% of the jobs that have been added are paying more than $24 an hour. So the picture's a little bit better than you'd think there. But yeah, there are a lot of low-paying jobs as well. It's certainly better than no jobs, clearly, but it's a lot more healthy than I thought after I read that fact. A little bit longer term of a picture, just in the trailing year, 1 year ending in June by asset class. Really not too much dispersion, but again, very strong equity growth in the last year. U.S. large caps, as measured by the S&P 500, up about 24.5%. Again, this is the trailing 12 months ended in June. U.S. small caps up about 23.5%. Developed non-U.S. stocks also up about 23.5%. And then emerging markets has been the nice story. Emerging markets and emerging market small caps, so large caps and small caps within EM are both up about 14.5% in the last year. So we've had a strong rally there in the last 8 months, which has been nice to see. On the fixed income front, the Barclays Aggregate Index is up about 4.4% in the last year. So again, despite all the noise surrounding rising interest rates, rates actually have declined so far in the year in 2014, hence further appreciation of the Barclays Aggregate Index, which is U.S. fixed income, U.S. investment grade fixed income. Currently, the 10-year Treasury is at 2.5%, and that's down from about 3% at the beginning of the year. So again, a lot of speculation about rates rising, but we're still sort of in this declining environment. The latest update from the Fed came yesterday from their most recent meeting. Really not too much on the rate front. They were sort of quiet about that again. The real news was that they will be completely winding down the asset purchasing program by October. So that's something that's already been in the works for several months now, and they're continuing to wind it down, but that will cease in October. And we're hoping next month there'll be more information on the interest rate front. Turning to the performance report, very briefly, the portfolio is up to $658 million. Again, that's from, you heard from the actuary report, from about $626 million at the beginning of the year. So very strong growth in the 2013 calendar year, and again, very strong growth so far this year. On the allocation portion here, you can see under the global equity in the gray bar, currently at 66% versus a target of 60. That's running up against our max range there. On the flip side, the global real assets are fairly underweight. That's just a result of the commodities not having been funded yet. So that equity overweight will come down, and that real asset underweight will come up as soon as we fund the commodity manager here. Really, asset allocation, as you all are aware, explains most of performance. There's overweight to equities, so that's going to be good news in the environment that we've been in for the last year and a half. Flipping to page 2. Kind of slow month in July, year-to-date, solid, below average equity performance, but farther out is where we should be focusing. 1 year, 17% advancement of the portfolio. That's nearly a full percentage point above the policy index. And just looking down into each asset class bucket, it's pretty clear where that performance is coming from. Again, it's from the equities, U.S. large cap, U.S. small cap. Even long short's been pretty additive there. International's done well, and even fixed income, even though that's a drag in this type of market environment, when you have your PAMCO in there and your Brandywine, those have both been very solid additions, have added extra yield in the low interest rate environment that we're in right now. 5 years, very strong numbers, again, 12.5% annually for the last 5 years. That does not include 2008 anymore, so that's off that track record. 10-year, of course, does still include the downturn. So really, it's all a healthy picture. We can dive into some managers if you like on page 3. Really, the only manager that is sticking out performance-wise is Wasatch, and luckily Wasatch is 1% and some change of the portfolio. They've nothing structurally broken with them. We've been talking with them a lot. They have a lot of mean reversion with investments that did really well, specifically out of China, that really have taken a hard hit in the last year. No real concerns there. We do have their investment team in our office in the next month and a half or so, so we'll get a clearer picture there, and we'd be happy to report on that probably in the September meeting. But no concerns elsewhere. I think everything's looking very solid.
Okay. Anybody got any questions? Any questions? Any board members have any reports or anything other than the board meeting in October? Myself and Ken both will be down in Dallas, so we'll need to change that. We're going to look at it and make sure maybe we can do it on the Wednesday before. If that's so you can all kind of put that on. Better results, yes, sir. We'll expect better results, yes. So, kind of look at that. Other than that, I just want to say, we're $658 million. In 1994, we were $151 million. So I think this system has done marvelous. Okay. Anything else?
I was just going to add the August meeting. We'll have the small cap managers in to provide an update.
Okay. All right. Is that 3 of them, or just 2?
Ernest and Times Square.
Okay.
Yep.
Anything else? Any other thing? If not, we're adjourned at 12:26.